Today, I'm joined by our Chief Operating Officer, Joe Harris, who's overseen $1 billion in loans here in Brevard County. We're breaking down what actually happened in 2025 and what to expect in 2026, covering rates, prices, and affordability. By the end of this episode, you'll know exactly how to navigate the market moving forward. Let's get into it. Thanks for joining me, Joe.
Thanks, Lindsay, for having me.
It's so nice to have you back.
I feel like we were just doing this a year ago.
We were just doing this a year ago.
It was a short year.
It feels long and short at the same time.
Right. I was half kidding. It's been a heck of a year.
Yeah, it certainly has. And this is one of my favorite episodes because we get to talk about everything that we predicted, what actually happened, and what we're thinking is going to happen for next year.
Right.
Awesome. So let's dive into it. We're going to go over a little bit about inflation.
Okay.
We're going to talk about mortgage rates, and
Yep.
we're going to talk about inventory and supply. How's that sound?
That sounds great. Let's do it.
Awesome. All right. So last year we said that inflation had to come down before rates could really improve.
Mm-hmm.
Did that actually happen?
So rates did improve this year. We probably had about I think at the beginning of the year we were about 6.6% on average. And towards the end of the year, we got towards 6.2% on average, according to Freddie Mac. And so we improved, what is that? Almost 0.5%, 0.4%. Inflation did improve through the year. The big concern were tariffs. Everyone was concerned that tariffs were going to cause more inflation. And when they didn't, then the Fed started dropping rates, their rates. And then, we did see price improvement through the year. We did see inflation come down through the year.
Awesome. So why is inflation still the gatekeeper for mortgage rates?
Well, if inflation, think about it this way. If inflation's at 4%, right? Would a bank want to lend money at 3%? Probably not, because they'd lose money.
I was going to say, is this a trick question?
It's not. But
Okay.
So if banks lend money at 3% and inflation's at 4%, they're essentially losing 1% because they're what they're lending that money out isn't even covering the inflationary costs. So that's just in a nutshell. But the reality is that inflation is the same people that buy mortgage-backed securities, which dictate the price of mortgages on the street, they're buying treasuries and other things. And so if they are buying them, typically the price goes up and the yield comes down. So you have lower rates if they're being bought. If they're being sold, if more people are selling than buying these mortgage-backed securities, then you have lower price and then higher rates. And that's what we saw in the past. People were selling mortgage-backed securities, the biggest one being the Fed, and because they were worried about inflation. Because when they buy these things, this is in the simplest terms, when they're buying mortgage-backed securities or they're buying treasuries, they are putting more money because they have to print money in order to pay for them. Mm-hmm. So that is putting more inflation out there, whereas when they're selling them, it's trying to decrease inflation. Does this make sense?
It does make sense. I was actually going to ask you, you had mentioned tariffs. For those that don't understand how that impacted things, can you explain that a little bit further?
Sure. The tariffs, when we put a cost on goods coming into the country, people were saying, well, that cost is going to be passed on to the consumer. Mm-hmm. And so it's going to cost them more, which means if you pay more for something, that is inflated, right? It's inflation. But it didn't happen necessarily that way. Sometimes it was consumed by the profits of the company, but you also had other things going on at the same time. The price of energy came down, and when the price of oil is, in my opinion, the biggest contributing factor to inflation, because oil is included in the cost or the construction, the building, pretty much of everything out there. And as oil prices came down a little bit this year, you saw your prices come down at the pump in the last year. Well, that helps bring inflation a little bit down. But so if it's going up over here and down over here, maybe we had a net down effect, which is what we saw in inflation this year.
Sure. With all that being said and all of your knowledge and everything that we've experienced this year, what are your predictions for inflation for 2026?
There are a lot of, not to get too political, but we're a couple tweets away, good or bad, from things happening or not happening. But we're really looking at inflation might not be the driving factor this year. We're going to look at jobs, because the Fed has a dual mandate, they call it. They look at jobs and they look at inflation, and they want to keep both in check. Now, we just had a little bit of a surprise. The inflation ticked up from 4.4 to 4.6, and that threw people for a loop. The Fed had said at the end of this year that they might not raise, lower rates as much in 2026 than previously talked about. And now that might change depending on the jobs. Inflation's always going to be a concern because it does affect most people's pocketbooks, their wallets. And so I think we're going to see if energy costs can get under control, there's this whole stuff going on with Venezuela, there's deals that we've made with the Saudis. So if energy costs can continue to drive downward to a point, that's certainly going to help bring inflation down. As we see more trade deals being made throughout the world, you're going to see tariffs be less of a thing. So all these things will be out there. Now, if we do continue to lower rates with the Fed, the problem is going to be inflationary concerns because they have to literally print money to buy these mortgage-backed securities and treasuries.
Yeah.
And printing money puts more money in the economy, and things tend to go up with the printing of money, and then we have inflationary.
Right.
So we have a lot of factors. But all in all, I know I just spoke a lot, but all in all, I think we're going to see inflation come down a little bit, but we're going to see jobs be a concern, mainly because of technologies, AI, right sizing, all the things you want to say. We had full employment for a long time, but technology might force some people out of the labor force.
Right. Well, speaking of people's wallets,
right?
Why didn't mortgage rate cuts lead to immediate mortgage relief?
Fed rate cuts. Yeah. Fed rate cuts. Okay, so the Fed dropped the rate, I think, was it 3 or 4 times this year? And going into that, the mortgage-backed security markets were front-running the Fed because the Federal Reserve, the FOMC, the Federal Open Market Committee, the rate that they have doesn't affect mortgage rates directly. All right. Now, the same factors are looked at, but they don't directly affect mortgage rates. And so going into the Fed meeting, the people that trade the mortgage-backed securities, which do affect mortgage rates directly, they're already trading those markets. They know the direction the Fed's going to go. They front run it. So by the time you got to the Fed meeting, it had already been baked into the price of the mortgage rates. And mortgage rates tend to go down into the Fed meeting where they knew the Fed was going to, they thought the Fed was going to lower the rates. And then right after the Fed meeting, we kind of saw a retracement. And then we saw that the rates went up a little bit actually after the meetings, and then they'd come back down. And so this year we saw that that push and pull all year long. Yeah,
I vividly remember all of the Fed meetings, and everyone was kind of waiting with bated breath to see what was going to happen.
Right.
What's your prediction for next year as far as mortgage rates are concerned?
Let's go back a step. Going into those Fed meetings, we were telling our customers that to lock in going into the Fed meeting. Mm-hmm. Because the rates, history showed us that the rates were better going into the Fed meeting than they were directly after. And some people wanted to wait. Okay, well, the worst, more bad could happen than good in these specific instances. Not to say that past performance is going to dictate what happens in the future, but in those specific instances, we had already dropped going into that Fed meeting. So we advised them, hey, listen, do what you want to do, but this looks like a good time to lock. The rates could be higher after the Fed meeting.
Yeah.
As far as rates for next year, 2026, this year I believe, if history it serves me correctly, I said that the rates were going to be what this year in 2025? Do you remember?
6, 7.
6, 7. Oh God.
You nailed
6,
it, Joe.
7.
It was the year of 6, 7.
I did say 6, 7, didn't I?
Yeah, you did.
All right, and we saw some pockets in the 5s on certain types of loans, but for the most part, we were in the 6s. In the beginning of the year, it kind of freaked us out with some 7s in there, splashed in there. But the trend was down throughout the year. So we ended up, I think we're somewhere, according to Freddie Mac, somewhere around 6.2% right now. We have a week left in the year, so I don't think that's going to drastically change between now and the end of the year. So we started at 6.6. We went down to 6.2-ish%, so almost 0.5%, 0.4/10. Next year, I do see us. Listen, I've said this before. That the last couple of years, I had what was called a hopium. I hoped the rates were going to come down.
Joe Hopium Harris.
I really hoped the rates were going to come down. But the macroeconomic picture wasn't conducive for it. The price and technical analysis didn't even suggest that. I look at what's going on right now in the marketplace. I look at very technical analysis on the mortgage-backed security, these candle charts that I look at, and the trend has been downward this year, but we're bouncing up. We're trying to break through a ceiling of resistance on the price of the mortgage-backed security, and we've hit this thing 3 or 4 times in 3 years, and we've hit it 3 times in the last year. So we're getting closer to breaking through resistance, which would be very good for mortgage rates. We would see that would, typically when you have these types of patterns, there's a 70%, 60-70% chance it breaks to the upside. Lower chance it breaks to the downside. And we're about to feel that break. And what could push us over that break is some macroeconomic news, such as some weakness in the labor market. Inflation data coming in good. Something that happens on the bigger, geopolitical scale. Don't know what that could be. Don't want to start predicting coronavirus or something. Don't hope that never happens again. But the reality is there's a lot of potential for the rates. When I say the price of that bond to go up, which would drive mortgage rates down, there's a lot of potential for that to happen in the near term. So I'm looking, maybe I'm cautiously, hopelessly optimistic, but I'm looking at rates to be, in the 5s and 6s this year.
All right, Joe, so let's get a little bit into the inventory and supply. So this year, inventory did go up in 2025. Am I correct in saying that?
Yeah, I don't have the exact figures in front of me, but I do know that we have an increase in inventory, at least in our area on inventory. Mm-hmm.
So why didn't that lead to falling prices?
There's a couple things. First of all, we were just filling in the supply that wasn't there before. We had such a decreased supply in 20 and 21. I remember at one point there was like only 400 homes for sale in Brevard County.
Oh gosh, I remember that. Everyone was panicking.
Right? And then in the past we've had 10, 12,000 homes for sale when there was 100,000 less residents here. And now we're somewhere in the middle of there. So we're at like a normal supply. And people are holding out. They don't want to get rid of their 2% mortgage, so they don't want to put their house on the market. And they're not really interested in selling, and they're not in a hurry to sell, so they don't want to give it a decreased price. And everyone thinks the rates are going down, and everyone thinks that home prices will stay steady. We might have seen a small decrease in price in certain areas in Brevard County and in Florida, some areas more than others. I know there's record sales in like Palm Beach. They're selling lots that aren't even on the water for like 60, 70, 80 million dollars. So it depends on which bracket you're in. I'm certainly not in that tax bracket. But there's properties that in some areas were hit harder, like on the west coast of Florida, where there's a lot of Airbnbs. They were hit hard by the hurricanes in specific areas. I'll leave them nameless, but they might have taken a 10 to 20% hit, where we've seen prices decrease in certain areas, maybe 3%, maybe 5%. Now I know there's a lot of people out there that are going to be like, Joe, but it's worth so much less. We're going to see a crash. But for many years, people have telling us we're going to see a crash in real estate. I haven't seen it yet.
Yeah, you had mentioned that at the height of things, when people were frantic about the supply and inventory, builders tried to overcompensate during that time. I don't want to say overcompensate. They tried to keep up with the demand at that point in time. So let's dive into the builder market. What's going on with builders? Are they making enough homes?
Nationwide, I said this maybe a year or two ago on this show that we did, and I said purely on a demographic, just numbers, we have something like 30 or 40 more million people in this country in 2020 than we had in 2008, all right? And in 2008 to 2014 or so, the builders, there's no reason, they stopped building. They cut back, they didn't really build. And so because of that, we're now seeing a shortage in homes. You add 30 million people, you didn't add 30 million homes or places to live. There's a shortage of homes. And that's really why we've seen prices stabilize. There's more people in this country, and there's a shortage of homes. So the builders, it depends on which builder and how much they build. And they did slow down a little bit in 2025 in certain timeframes. But overall, can they build enough homes nationally? I still think we have a shortage of homes nationally.
Yeah.
Did they overbuild in the last couple of years? I don't think they did.
What would be your final prediction for supply for 2026?
I think we're going to – it's such a tough question, because if the rates do come down, which I do believe they're going to come down to maybe the 5s, 6s on average.
Not 6, 7s?
Nope, not 6, 7s, not 41. But, they're going to come down to maybe the 5, 7s. I don't see drastic 2 and 3s and 4s. I see pockets of 5s, more pockets of 5s than we had in 2025, and mainly stay in the 6s. But you might see them push down a little bit. But the reality is that the people that are going to sell and want to sell and have to sell are going to sell. It's not going to drive the people that say, I'll sell, for the right price. If I can get a 2% rate, then I'll consider selling my house. But we'll see a little more people come, more people come. The supply will go up a little bit, but nothing drastic. I don't see a drastic sell-off, at least where we live in Florida.
All right. So let's tackle a little bit of the affordability conversation. Did affordability actually improve in 2025?
Yes. Yes, it did. Did it improve drastically? I can't say that. But if you have rates come down by 0.4%, that's an improved affordability. In Florida, we saw more insurance. The insurance was a tough part of affordability, equation, because you have your payments made of your principal and interest of your loan, which is driven by how big your loan is and the interest rate on that loan. It's taxes and insurance, and if you have any mortgage insurance, and if there's an HOA. But those factors are those are the variables. Principal and interest on the loan, that might have come down a little bit because the interest rates came down. Taxes always go up, and I'm dumbfounded because your local municipalities, they increase taxes and the home values are going up. They have this increased tax revenue. I don't know what they do with it. And one thing that's on the plate for Florida is to get rid of property taxes. And I know people are widely opinionated on this fact. But the reality is that would drive down home affordability.
I was going to say, can you explain what that means to the local Brevard County residents?
Well, I don't know yet because it hasn't been put on the ballot yet. But I know Governor DeSantis is looking to put that on the ballot in 2026. Now, how are goods and services going to be paid for? What happens? I haven't studied that enough. I haven't seen a bill introduced yet. But the fact is that would drive a lot of demand to the state of Florida for properties.
So what would be your final prediction for affordability for 2026?
I do believe that interest rates are coming down. I do believe insurance costs have come down, and it's continuing to improve there. I mean, for the last couple of years, we had a real hard time with insurance. But now Citizens has reduced their load. They've gotten a lot of policies away from Citizens, which is Florida's pool of insurance. And it has, if insurance costs have come down a little bit, if interest rates come down a little bit, taxes, if they go away, that would greatly improve it. But even if taxes would, level out, or we demand to see what they're spending our tax dollars on, geez.
God forbid.
Yeah, I mean, there's some municipalities that have gone nuts, but we don't need to get into that. But point is that could definitely drive affordability in a more positive direction.
Let's dive into home prices. So what does a flat price year tell us about the health of the market?
Well, if you think about this, if pricing is flat, and we've been in an increased rate environment for 3 years. I mean, it was really 2022, April of 2022 when interest rates started to rise significantly. And we've been higher on the rates, higher. I mean, 6s and 7s aren't terrible, but the perceived cost did go up. The actual cost did go up from where we were in the 2s and 3s and 4s. And, if you think about that we were able to maintain or maybe just lose a little bit, that says a lot about the market. That means that if the price did dip down, there was a buyer to swoop in and buy it at that price to keep the rates or keep the prices where they are. So unless demand goes down, right, unless supply continues to rise at bigger rates, I still don't see. I've said this 3 years in a row. I've been challenged every single year. Someone's like, well, the prices have to come down now. The rates have been high. We're going to have a crash and all these things. It hasn't happened yet. People are just saying, just you wait. And they might be right eventually, but I just don't see it this year. Maybe there's a little bit of period where they start to go down, but the second they do, rates are going to come down and people are going to swoop in and they'll come right back up. That's my guess, my opinion. I could be wrong.
You're entitled to it.
Thank you.
With all the things that we discussed today, we did see over this past year a big shift in the agent pool. I think locally as well as on a national level. With a smaller agent pool change, or does the smaller agent pool change the experience for buyers and sellers?
Now, when you say smaller agent pool, you just less agents are in the business?
Certainly, less agents. I think over the past couple of years, some people decided to get out of the business or slow down their business.
Right.
There was a lot of people retiring and not as many people coming into the occupation.
Okay, so, I mean, how's it going to change the consumer experience? We've had a lot of changes. I mean, we had changes with the way agents are paid on the buyer side, right? We had the way they have done business has shifted. And I think we're going to continue to see an evolution in that because the information is out there. I mean, at one point, the agent had the book of the MLS and they were the keepers of that data. Well, now they've given that data to everyone else out there. And so that data is not protected. So agents, the ones that are left, I mean, they're professional. Not to say the ones that left aren't professional, but this has to be a primary source of income. This has to be something that you constantly are evolving your craft to be the best that you can be. Because if you're not providing value to your customers, your clients, then you're not going to make it. And so I think we're going to see agents continue to add more and more value in other ways, which they do. It used to be they had the value of being able to have the data. Well, that went away, and they created value in more and more different ways. So I look forward to seeing that evolution. And agents they're probably going to end up, their commissions have been under fire for a long time. And so I see a day where, if their commissions are further driven down, they're going to have to use AI and technology to handle a higher customer base and just provide more and more value to the customer.
Certainly. Well, that brings us to the last question.
Okay.
Which is, what is your prediction for home prices for 2026?
Can I give any caveats, or do I have to, you want me to give you a percentage or a number? Well, let me talk in terms of Fannie Mae and
Should we
Freddie
go
Mac.
based off of feelings and facts, or?
Oh, gosh. Feelings or facts? Which one do you want? I give you both.
Let's go with feelings first.
Let's do feelings first. I feel like home prices are going to stabilize or go up slightly 2 to 5% in our market in Florida. Okay. Nationally, we're going to see some pockets that they're going to take a price hit. They're going to take a price hit. But nationally, I see us flat to 2% increase next year.
Now, you mentioned pockets. Are there certain types of pockets that you think would indicate that, or what do you mean by pockets?
It's the flow of money. You got to watch the flow of money. People, if and I don't want to go too deep into this one, and I don't think you want me going too deep in this one, but it's just the flow of money, and where the money is, people will go. So, we had a migration to, when the oil boom was happening, when the price of oil was high, to like North Dakota. There's a huge, I think it was North Dakota, wasn't maybe it was Montana, whatever, up there in beautiful land, right? And there's a migration to go up there because that's where the money was going. And then when the oil prices went down, there was no work for them, so they left there. So, places with jobs are going to see more growth. They're going to see more home growth. Florida is really attractive to a lot of people. So I believe we're going to see growth in Florida. The states that are shrinking, they're going to see prices go down in certain areas in those states.
Yeah.
Does that make sense?
Definitely.
Okay. What was and you said the facts, right?
Mm-hmm. And the facts.
Well, here's one fact that you can hitch your wagon to just a little bit, that Fannie and Freddie, the people that buy a lot of the mortgages in the secondary market, they believe, it looks like they have raised their loan limits. I think they raised it up to over $830,000 for their conforming loan limits, whereas last year it was, less, 2 to 5%. I can't remember the number from this year, but they definitely raised it up, like 5, almost 4% or so. So, that says that they believe that home prices are going up. And they are one of the biggest aggregators of home data out there. So I kind of trust what they say.
Certainly. Well, thank you so much for joining us today. Thank you for recapping what we discussed last year and also giving your predictions for 2026. And for those of you that are following along with us, if you'd like to drop us a comment for more educational content, please do. We'll see you next time.
Great. Thank you. Thanks for having me.